2, 1.
Blast off.
Let's do it, man.
All right. Happy day after Christmas.
I don't want to say it's over like it was awful, and it was actually a great Christmas for us. Hopefully it was for you, but I'm glad to be moving on.
Yeah. Looking forward to 22.
It's always that time of the year where it's like, I'm glad we're here, and I'm glad to move on. You don't want to just get stuck in Christmas too long.
No, the stress of Christmas is kind of unbelievable. I mean, it's great. It always ends up great, but man.
Yeah, I did about as stress-free as I could possibly make it. Got all the Christmas presents early, did all that kind of stuff. But no matter what, it's just a little tension. Yeah. I don't know if that's a good thing or bad thing. There's always going to be a little, but all the family's healthy and everybody got to see each other, and that's about all you can ask for.
Yeah. These days, that's a win, no doubt.
It is. What kind of crazy stuff do you have for us?
We got a bunch
Santa
of
Claus
stuff.
rally, is it still a thing after Santa Claus came?
Santa Claus
came.
So yes, Santa Claus rally. We're going to actually talk about quite a bit in this, what the actual definition is and all that. Mm-hmm.
Does it involve a Grinch?
Yes, a potential Grinch. Yes, actually, and there's a Wall Street kind of colloquial term for, it doesn't say Grinch, but it says what happens if Santa Claus doesn't show up.
Yeah.
And so
Santa Claus is not trademarked, but I think the Grinch is. That's probably why they had to come up with a different word. Yeah. If you guys haven't figured out, you're watching this show, like I never know really. I don't know at all what Jerry's going to say. And we kind of do that on purpose, right? So I can just react to it like you guys would as he's going along. But I never see the slides. I don't really know. Yeah. I mean, he kind of gives me a little idea of the topics. But other than that, I don't know.
No, this is good to just come off. And we never do more than one take of this, right?
No, this is one and done, folks. If we screw it up, we keep rolling.
Yep.
Yeah, and we screw up every show, so we just keep rolling. All right, man, let's knock it out. What do you got for us?
Okay, so here we go. First thing I have to get on a little bit of a soapbox, only because I need to talk about it. We talked about this idea of
this keeps coming up lately.
It does, yeah.
So weird that all of a sudden, and we literally talk about it almost every show.
Yep.
Maybe we don't write it in every post, but we talk about this topic all the time.
So this idea of whether or not, like how much money you and I have in TSP and
we have
rollover, skin in the game, all this. So we did the first public Facebook group webinar in November, right? It was about whether or not to roll over from TSP. And in that, we talked about the pros and cons of having, some of your money in TSP, maybe rolling partially over for different reasons, why you would want to leave it all in TSP, depending on your circumstances and how much you wanted to get educated about active management and all that.
Because these are all, and this is because people told us this is what they wanted to hear.
Right.
This is why we picked that topic.
Right.
People were constantly asking. We don't get a lot of data from Facebook and our stuff, whatever, but most of it tells us that we generally have two kind of age groups. We have somewhere between like 20, I think it's 25 to 35, and then it's 50 to 65.
Yep.
As the two big chunks.
Yep.
And of course, got everything in between. And so that didn't surprise us that people in that 50 to 65 age group are like, what do I do with my money?
Right.
So that's why we talked about it.
Right.
And we happen to be in that age group.
Yes. And
on the low end. Very low end.
Yeah. But we were in that group because we retired, right?
Yeah.
So, you did a medical retirement. I retired in the law enforcement, firefighter, air traffic controller. It's 6C, it's called, right? The retirement system. In that system, you have to retire by the time you're 57. Mm-hmm. You're able to retire under some circumstances at 50. At most circumstances from 52 to 57. So we were in that eligible bucket to retire. Mm-hmm. And so if you're in there and you're looking at it and you're going, okay, what do I want to do with my TSP? And that's what that whole show is about.
Yeah.
Right? And somehow what spun out of that is that, these guys did a rollover. They don't have any skin in the game anymore. They're not even in TSP. Why would they even talk about TSP, whatever? And so on the members only webinar that we did in December, we talked about this quite a bit, right?
Yep.
And I showed a slide of my personal TSP account, and I'm going to show that slide again here on the public group because
you're by the way, if you guys don't realize like how transparent Jerry is, I'm not sure I would be as transparent.
Nobody would do this.
No. First of all, disclaimer, right? We're not financial advisors in this capacity. That why I say it that way is because we are financial advisors in other capacities.
Yep.
Not in this one. Education only. We don't do financial advice. There's legal reasons for that, and there's practical reasons. And most of the reason is because we can't give you financial advice because we don't know your circumstances.
Right.
What we can do, and this is why we created this whole thing, Grow My TSP, is nobody educated us when we came in. I came in the government. We both started in the military and the government, right? But I'll lump it all together. I came in 89. You were 90.
90.
Yep. But Jerry was older. I just came in as enlisted. So he came in after college. But the point is, that's how long we've been in the government, right? I left in 2015 from the civilian government. I just retired from the military, stayed in the reserves after I got active duty.
Yep.
So we've both been in the game, skin in the game, for over 30 years.
Yep.
I rolled over my civilian side for all kinds of personal reasons, right? Which is none of anybody's business, except that what we know from that is you all have personal circumstances the same. You have divorce, you have elderly family that you might want to take care of. You kids
in college,
get sick, kids going to college.
Yep.
All these kind of things can happen in your life that, whether you like it or not, impact your retirement account. I don't care whether it's TSP, 401k, TSP, IRA. Personal circumstances in people's lives affect your retirement account. Would you agree?
Absolutely.
Okay, so if all of you have those issues, we've been through them too, and that's why none of it's perfect, right? And so somehow, though, the takeaway was that we didn't have skin in the game. And it's like, I don't know how much more skin I could have.
No, I'm going to explain exactly my skin in the game. Yeah.
Why I kept my military TSP, but I the best option for me at the time was to roll over my civilian TSP for all the reasons we talk about all the time, which is on the IRA side. I'm way younger than I am, like, really retired, right? And I've got so many more options. Blah 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 blah. Like we've talked about this so many times, and so no, the best option for me was to do that. I didn't need to leave a big chunk in my civilian TSP because I didn't need to live off of it or get access to it, right? And I'm sure you're going to talk about where you needed a little hybrid version where I need to have access to some, but I want to keep making this other part work for me, right? And I let the military part work for me. It wasn't as big as a pot, but it's still working for me. So anyway,
we're going to get into a little bit more.
Let's do it.
Okay, and then the Santa Claus rally, we're gonna go through what that is, and the potential Grinch piece of it. And then we're going to I got a slide, it's like a 5-page slide deck, which I'm going to go through all 5 pages, but just point out the highlights. It's from the company's called Elliott. They're the ones that are that the government contracted with to provide our mutual fund window. Then we're going to look real quick at the Elliott Wave count with the Andrews Pitchfork. Grayscale Bitcoin Trust is the bonus chart, and then we'll do the 2-year weekly charts. Okay. So, like we said, there have been a ton of comments on both the Facebook public group and the members only group about us not having skin in the game because we did a rollover from TSP to an outside IRA. So I just want to address kind of some of those comments and set the record straight. So both Conan and I have been really transparent, right, regarding the pros and cons of the rollover from TSP to an outside IRA. We did, like we said, the whole public webinar back in November on this topic. The link is at the bottom if you, typical. Okay. There's the link. If you go to that link, put it in your browser.
That's the link on Vimeo of the
November webinar.
Right. Not of your TSP. I was looking at that page. It's not of that picture. It's the link to the webinar we did.
Correct.
And I'll do my best to post that link as a real link in the comments for this. But
so that's the link to the webinar that we just talked about. Definitely you want to go take a look at that webinar. Okay. The slide is my personal TSP account. All right. So I took this slide on December 8th, okay, and it was part of the members only December webinar. So as of the end of the day on December 22nd, right, so fast forward to today, the slide was from December 8th. I had $156,402.14. When I started putting this slide deck together for the show, it was December 22nd. My balance was $155,827.85. That amount is increasing because the market went up on Thursday and it's not taken into account here. So it's going to be somewhere north of 155,000, whatever. The point is, I clearly have skin in the game in TSP, unless you consider $155,000 plus to be insignificant.
Which, if you do, good for you.
Good on you.
But yeah, even if that's only 10% of your account, that's 10%. Is a lot of money in any any rational
hopefully
person's,
anybody's world.
Yeah, exactly. Yeah. So yes, got skin in the game, and yes, did roll over for many of the reasons that if you go back and watch the webinar that we did, you'll understand, because in that webinar we talked about why, and most of this really is it's just odd to me. And I think what I like to think to myself is, we got like 15,000 people in that Facebook group, and it's really only about 15 or 20 that have comments like this, and maybe we're only addressing them, and the rest of you are like, I don't know what you're talking about. Like, I haven't seen any of this, and I don't care. If that's the case, then great. That's the way it should be, because the purpose is here for us has never been that, we've done it better than you. We're experts in this. We have never said that. What we're saying is, when we came into the government, no one gave us any education on how to manage your retirement. At all. Right. And now, even more significant, so we talk about 6 million people in the TSP, active, users, account holders in the TSP. Most of the majority of those are DoD TSP, right? Military members. Now, why do I point that out? I would argue to the nth degree that 0% of those are TSP millionaires.
Yeah, for sure.
One, it didn't used to be important.
Well, and it hasn't existed long enough.
Yeah, it hasn't existed long enough, and even when it did, it wasn't important to your retirement as it was on the civilian side. Right. Now, because of the BRS, blended retirement system, it is extremely important. And people haven't had time to build those balances, even if they were active, right? And so there's a huge problem there. If you're an E1 or E2 or an O1, O2 coming in to the military, and you don't start getting engaged early, man, you're the retirement days are going to hurt, because you're not going to have anything there. The pension, the annuity is not there anymore.
Hopefully in the military, at least the idea of doing a 20+ year career might still be there, but the idea that you don't get a retirement at all unless you do that complete 20-year career, that's kind of gone away with the blended retirement system. Which is
a great, I want to say great thing, because there's plenty of people, myself included, who stayed in after 10+ years because you're like, I'm already over the hump. Right. I got to, whether you really enjoy it or not, all these things going on, but you stay in because you want to get that annuity. Yeah. And so now you could do 10 years in the military, be really active with your TSP account during those 10 years, and roll that over to an IRA and move on to the private sector, and maybe stay in the reserves too, whatever version of that
all
is.
All kinds of options now.
Lots of options. Yeah. And I know you're going to get to this with the idea of the mutual fund window. You might not have as much of a desire to roll it over as I did, right? I rolled mine over because I needed more flexibility. Yeah. I needed more than 2 moves a month. I didn't want to get the closing day price at, I didn't want to have to do it at noon. Right. I didn't want those restrictions, because I know how to actively manage my account, and I want to be able to use the tools. Yeah. You open that mutual fund window, there may not be as many reasons to roll over after 10 years, but you still leave in the military and you get something out of it, right?
You know what? That kind of is an interesting point. I have no idea if the mutual fund window applies to the military side of TSP.
Yeah, we haven't gotten any word as to. Yeah. I would be amazed if they somehow segregated it. Yeah. You'd have some problems. People would be very angry. So I have to imagine whatever the rules they put in place, because right now they both match up. Right
now they do.
Now they do. They didn't. The only thing that didn't used to be the same was we got no matching. Right now we get matching because we have the blended, and now it's way more valuable. And so again, I bring all this up because You talk about 6 million people in the TSP. The majority of those now are military members, and they are getting no education,
right now.
Way less than we did on the civilian side. At least on the civilian side, you get a little HR thing, and and you get some of that when you come in the military, but you're going through basic training.
Yeah, you don't have time for all this.
You're not thinking about that. There's probably a class.
Important stuff to do.
I guarantee you somebody from S1 gets up there and goes, you need to pay attention to your TSP. And I guarantee you that private or that lieutenant is like, when's chow? Oh my God, I'm so hungry. I've been up since 4 a.m. They're not thinking about this. So what we're hoping, I'm going to beat this to death. I'm just hoping that we can educate some people. We both hope that. We got kids in the military, both of us. We have skin in this game is where I'm getting at. We can't possibly have more skin in this game.
All right. That's point one. Skin in the game is point number one from this chart. Okay. Right. Point number two, actually much more important, right, than whether or not we have skin in the game. Why? So the comment is, hey, you guys aren't in TSP anymore, which obviously is not true, unless, again, 156,000 isn't in TSP. But the question is, why would anybody who's a retiree keep any money in TSP, right? So I'm 53 years old, retired under the Leo firefighter air traffic controller, right, 6C retirement program. So that means I get a pension, and I can withdraw my TSP just like any other retiree can without an IRS penalty before age 59 and a half. So any money I roll over out of TSP into an IRA is subject to that 59 and a half age rule, which it's a 10% IRS penalty on top of income tax that you pay on any amount that you withdraw before age 59 and a half. So those 59 and a half rules don't apply within the TSP. So I left $150,000 in my TSP when I did the rollover in November, and the majority of the money I had generated in TSP over the years, I rolled into an IRA at Fidelity. Okay, so the benefit of the rollover is that I have access to a universe of stocks, mutual funds, options, crypto, like whatever I want, and none of the TSP restrictions. I can trade within that IRA every day if I want. A lot of times I do. The downside is that if I withdraw any of the money from that IRA before I turn 59 and a half, then I have to pay the 10% IRS penalty plus the income tax. Okay. So I left $150,000 in TSP as a backstop, basically, right? It's an insurance policy in case I need access to that money over the next 6 years, right? Until I turn 59 and a half. Otherwise, if I didn't need that backstop, I'd have rolled all of it out of TSP into Fidelity. So ask yourself, if you don't need to access the funds until you're older than 59 and a half, why would anybody leave money in TSP when you could roll it into a vehicle that has no trading restrictions? It's a no-brainer. Like, these Facebook comments are ridiculous. Okay, and I trade my Fidelity account using the exact same methodology that we're teaching in the weekly update show.
Yeah, when we do alerts, I move my money the same way.
Yeah.
I treat the alerts that Jerry sends out. As a matter of fact, right now, I am comfortable in the world of CSNI, right, and the versions of that on in our IRA, right. So the VXF, SPX, and EFA. I'm comfortable in that world, and I know that I can perform well, and so I'm not doing anything really different. Now, Jerry does like to look at some other things, and I do a little crypto, but by and large, though, the point here is that even in our IRA, we're using the exact same methodology. We're using the exact same, data points. Yeah,
and when we get to the mutual fund window next summer, we're going to be doing the exact same methodology. We're going to have more options to do it against with more products.
But you all will see that we're not going to be using 5,000 choices. No. If there's 5,000 options, we're not using all 5,000. First of all, a lot of them are just duplicates, and a lot of them are worthless. And, you guys will see how this plays out. It's the methodology that we use, which is not that difficult to understand. If you take time to read our ebook and watch our webinars, you'll see the methodology. Now, that doesn't mean that you have to agree with that methodology.
No, right, of course.
But you do have to agree that we're actively managing it. We're not passive.
Yep.
And that's our come from.
Yep. All right. So that I got to get off the soapbox there, but that's that. I mean, hopefully that, for whoever at least watches the show, it'll put to bed the idea that we don't have.
Well,
any
can we address
the
last line down at the bottom? Can we talk about?
Oh, you want to talk about that too?
Well, I think because there's been some public comments about why haven't you updated the PIP on your site? Yep. Well, the reason we haven't updated the PIP on the site, and we will update our performance data. So we used to put up our PIP from
put up the chart real quick.
Exactly what TSP gave us.
Here on the chart?
Yeah, so zoom in on that and read it, and I'll not read it, but so when we did a rollover, this happened to me years ago, but it happened to Jerry recently because his rollover was more recent.
Right. So let me just say, so your personal investment performance could not be calculated because monthly account balances for the entire year were not available. So what happened was I did the rollover in November, and the TSP uses the modified Dietz method to calculate PIP. And we always talk about how PIP is it's affected by cash going in and out of the account, right? So if you're paying off a loan or you're contributing 10% versus 5%, your PIP is going to be different from mine. It's not apples to apples, right?
Yeah. It's almost impossible to have it apples
it
and
is
apples.
Impossible.
Yeah, two people's PIPs are not comparable.
Right. I mean, your rate of return, that's a better way to compare. We've talked about all kinds of different ways you can compare apples to apples. The daily TSP app enables you to do that. But TSP specifically, they can't, because I did such a big rollover, they can't give me a PIP until next November on the money that I have left in TSP.
Yeah, and so we were just pulling it from there because that was consistent, right? We wanted to be able to get it from the same place. So we are going to recalculate our data and then have that be our norm going forward on the website. But we've had a couple people that just are obsessed with poking about that. And we're like, guys, first of all, go find anyone that does this stuff that's giving you any kind of glimpse of what their personal performance is. Yeah. But we're doing that. But it's going to take probably January. We got it figured out. We got some data analysts, data analysts taking a look at this to go, okay, once we find it, then we just keep it consistent. Because if you look at the performance above, we did a 5-year performance. That is not PIP related. Right. We did that on purpose. We wanted to give you our Sharpe ratio and our rate of return because that is apples and apples across the financial industry. And honestly, that's where we're going to head because it's now the part that sucks for us about that is if you're uneducated, right, which we're trying to educate everybody. Yeah. If you're uneducated or you're just want to be ignorant, meaning you know better, but you really just want to poke. And you say, well, I've got a 50% PIP, and you've got 20% return on rate of return. I do better than you. Yeah, that's not how it works. I'm sorry, it just doesn't work. Because here's what I'd love to do, and I know Jerry doesn't want to do this, and we've kept from doing this on the site. But I'd love to go back to the years where, let's say 2018, where the market was negative, and we weren't. Right? We don't make a big deal about that, right? We try not to just because if we're going to say that 1 year doesn't matter, we have to follow our own saying. So if I go back and say 2018, then we're not really following our own advice. And I know I just kind of broke our own rule. We want to look at big, long chunks. We want to look at 5, 15, 10 years. Those are important data points, right? Because that's what a career is. A career is not 1 year. If you did great this year, we're so happy for you. I get shivers.
Yeah,
right?
Awesome.
I am literally. I'm happy for you because that means everybody's doing well. Hopefully, whatever methodology you use is working for you. Now, we know because we've been doing this for 30 years that not every year is like that. And so that year where you take a 20% hit or 5% hit, and you're feeling like crap. We're not going to be happy for you either. Like we want you to succeed. Yeah. And you can. But you gotta get educated.
Yep. Okay.
Are we off the soapbox?
Off the soapbox.
Moving on.
All right. Santa Claus rally.
Woohoo!
Okay. So this year, the Santa Claus rally. So the definition of the Santa Claus rally is the last 5 trading days of the year and the first 2 trading days of the following year. So this year, Santa Claus rally starts tomorrow, Monday, December 27th, and runs through Tuesday, January 4th.
I think it's because Santa has more time on his hands right after
Christmas. All the wrapping is over. And
his rally comes after he's done running around the world.
Exactly.
Just in case any kids are listening.
So the first slide here, right, it's Investopedia. You can pull it up there if you want. Santa Claus rally describes a sustained increase in the stock market that occurs last week of December through the first 2 trading days of January. All kinds of possible explanations, general optimism because it's Christmas and everybody's happy on Wall Street. Maybe some institutional investors are liquidating or buying more stock. They're optimistic or pessimistic or whatever, and it all tends to be more bullish. Okay. Because nobody really understands why. So understanding the Santa Claus rally, it's a seasonal phenomenon that was observed first by Stock Traders Almanac. That's really the Bible of sort of seasonal trading.
And how long has that been around?
50s, I want to say.
Yeah, a long time.
Yeah, the guy who runs it now, his dad started it, so I want to say it's like the 40s or 50s.
Wow.
Yeah, so it's been around for quite a while. Since '69, Santa Claus rally has yielded positive returns 34 out of 45 holiday seasons. Last 5 trading days of the year and the first 2 trading days of the new year. The average cumulative return over these days is 1.4%, and returns are positive in each of the 7 days on average. So every day, historically, over the course of that Santa Claus rally time period, the market goes up, right? Okay. So pros and cons, and again, we're still on the Investopedia piece because in a minute we're going to look at a little bit different piece, but pros and cons. So chartered market technicians, right? One of the tests I took a couple weeks ago. Basically technical analysts. Pay attention to cyclical trends and try to figure out ways to exploit, right? Use that data to get in and out of the market during seasonally favorable periods. In this case, it's the Santa Claus rally time period. So you do that by, changing your position size, putting in stop orders, trying to cut your losses, whatever. Same things you would do throughout the year. It's just that with the backdrop of a seasonally favorable period, you would look at that a little bit differently. So it says here, none of this is useful for most investors who don't have trading experience to manage risks for short-term trades. For buy and hold investors, and for those saving in a 401k plan, for example, the Santa Claus rally does little to either help or hurt them for the long term. So if you are buy and hold, of course, any of the seasonality stuff doesn't make a difference because you're holding. You're not taking advantage or trying to. You're not taking advantage of the seasonally advantageous times, and you're not trying to manage your downside risk during seasonally unfavorable times.
Because you're not moving.
You're not moving. You're riding the market, right? It's fine. It's just that, again, this is an education piece, and there are times in the year that are historically seasonally advantageous to be in the stock funds, and the reverse. There are times of the year that are historically times when the market tends to go flat to down. So if you want to ignore those things, that's fine. You can do that, and that's what buy and hold does. You're holding it through the ups and the downs. That's all. So to the extent that none of this is useful for most investors, it's not useful for buy and hold investors. It's just something to talk about. But if you do actively manage your account, it's extremely useful. Okay. So from our friend Tsp Peretz at All Star Charts, and here's the link to his blog. I would definitely check it out if you guys haven't already. So the official period for the Santa Claus rally, December 27th. It's going to be to November 4th. First half of December hasn't been the best time for stock investors, which is true. It's been pretty much a roller coaster ride. But keep in mind that historically it's the second half of December that is the most bullish time of the month for stocks. So what should we expect from the Santa Claus rally? This is the thing that I love about JC. It's not about whether or not Santa shows up for the rally. It's more about what happens if he doesn't. Okay, so we're getting into the Grinch question. According to Irie Wald at Oppenheimer, since 1928, the S&P has averaged a 1.7% gain and traded higher 78% of the time during the Santa Claus rally period versus an average 7-day period, right? So in any given 7-day period that you pull out of the year, had an average of 0.2% gain, 57% hit rate during any 7-day period. But this quote is not from JC. This is a pretty old Wall Street adage. If Santa should fail to call, bears may come to Broad and Wall. So Broad Street and Wall Street are the intersection of where the New York Stock Exchange is. In other words, when stocks do not do well during the Santa Claus rally time period, it's usually a sign of bad things to come. So performance in the next 1 to 2 quarters has tended to be below average when the S&P 500 closes lower during the Santa Claus rally. For instance, the S&P 500 averaged a 1.2% loss in the subsequent 3 months following a negative Santa Claus rally versus 2.7% gain following a positive Santa Claus rally. So as we look at the next week or so, if prices continue to move higher, right? If the C fund continues higher, then we're in good shape going into next year. If it rolls over, which I don't think it will roll over, and we're going to get into why, but if it rolls over, then the next, first 2 quarters of next year are likely to underperform. It's just a historical education, something to think about, something to
It's use. A data point.
It's a data point. It's something to have as your basis for, okay, let's say the Santa Claus rally doesn't happen this year, and now it's February, and we're on the 50-day moving average line. Is my bias going to be it's more likely, historically more likely that we're going to get support here and keep moving higher, or is it more likely that we gap down through here and keep going lower, right? It builds the backdrop for your decision-making process.
Yep.
That's really all it is. At least that's what it is for me. All right. So Stock Trader's Almanac is a great resource. I haven't looked at this podcast yet with Jeff Hirsch, but he has taken over Stock Trader's Almanac from his dad, and I'm sure it's really good.
We said a lot of times, just to give JC props, that if you're if you're a technician, a market technician, you like technicals, he's got a great, a lot of free info.
Tons. Yep.
Yeah. And then if you're willing to pay, I wouldn't call it expensive. I think it's worth its value, but it's a lot pricier than ours.
It's like $2,700 a year.
Yeah. I think. Yeah. But it's a lot of great data. Now you got to remember, he's looking at the entire market.
Right. There's no point in spending $2,500 to manage the
TSP.
three stock funds and a bond fund.
But if you're in an IRA, it's a different thing.
When the mutual fund window opens, it changes things for sure.
He's definitely another data point to watch.
Yeah. Speaking of the mutual fund window.
Dun, 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 dun.
So we talked about changes that are coming to TSP in 2022. One of the most important ones is, from our perspective, of course, is the opening of what they're calling the mutual fund window. Okay. The company that provides the window is an HR services company called Elliott. You can find more about that company at elliott.com. That is not a commercial for Elliott, but that's where you can find out stuff about them. Okay. So the link at the bottom of the page, again, will take you to this 5-page slide deck that we're going to kind of go through. Don't get confused about the language. Okay. This part up here, 5 facts about a self-directed brokerage account. Okay. The mutual fund window is self-directed, meaning that we can trade whatever products we want within the window. It's not a brokerage account in terms of taxes, right? So normally on the show, we talk about a brokerage account. We're referring to trading in a taxable account outside of TSP. Since the mutual fund window is part of TSP, any of the gains made within the mutual fund window are still under the tax umbrella of TSP. Can't hear. You're off.
Which is a good thing.
Yes.
I mute myself on purpose sometimes. I just don't want to be quiet for you.
Yeah, because we talk about brokerage account, right?
Yeah, all the time.
Yeah, and it's a good distinction because that
very big
is distinct from TSP. But in this particular slide, I didn't want people to
in brokerage accounts. And this is going to send some people spinning. In brokerage accounts, some of my portfolio is in brokerage accounts, and I am more buy and hold in some of those because I don't want the tax implications. I don't want, because when I sell, I got to pay taxes on it. And I know that long term, because again, I'm not looking at the S&P 500. I'm not looking at indexes per se. Right. In my brokerage account, I can buy Apple or Tesla or whatever. And if I'm buying an undervalued company, in my opinion, well, you got to wait it out. That's long term. That's the kind of stuff that people like Warren Buffett are talking about, right? They're not talking primarily about,
index funds,
in a retirement account,
right?
Different implications, and that's why we're always kind of bringing it up, because again, we're here for education, and some people don't know the difference there. They really don't. I mean, I can't remember like when I learned it. I had to be in my 20s that I was like, oh wait a minute, these are two very different things. Yeah. And really, it didn't hit me till I was in my 30s, and I was like, because I don't know, in my 20s, I didn't think about taxes. I guess I didn't make enough money. In my 30s, I started, you're getting promoted, you're getting, taxes are a bigger deal.
I had this conversation with my daughter the other day. She's home from Penn State.
Yeah, and we have those conversations a lot now. My girls.
Yeah. She wants me to buy her, but she wants to buy.
That's how it always works.
A van, like a conversion van, right? She's been designing this van that she wants for probably 2 years, and she knows exactly how she wants to configure it. I mean, a conversion van now is like $100,000, not counting the van, right? You're gonna whether it's the Mercedes version or the Dodge version or whatever. There's all, and I think Econoline, Ford makes one. There's all kinds of different vans you can buy, but you got to buy the van. And then it costs about $100,000 to.
Then you got to
convert it, right?
Yeah.
So we started talking about it, and I'm like, okay. And we had just set up. I had a Uniform Gift to Minors Act account for her when she was a kid, and we transferred it over to her account after she turned 18. So, when she's at Penn State, she's Navy ROTC. She doesn't have time. She's a biomedical engineering major. She doesn't have time for all this. But I'm not doing it for her, right? I will help her 80%, but I'm not.
You'll educate her.
I'll educate her. I'm not doing the thing for her so that she doesn't understand how to do it herself, right? But as we're both talking through it, I'm like, all right, what can we do to generate that $100,000 out of the market so we can do your conversion event? And if you do, because for me, my purposes with her has been a retirement account, right? She's going to have her life in between, but at some point I want her to have, a decent retirement account at the end of the day.
Right.
So I haven't focused much on how do we generate some money that you want to use to be able to spend. And really, either you get an IRA account that's tax deferred, or you get a brokerage account. If you use a brokerage account, you can withdraw money from that brokerage account, but you're paying taxes on the gains that you get, the capital gains. And if it's short-term capital gains, because you're trying to trade your way there, you're paying huge taxes, right? Now, if you can put $10,000 into a brokerage account and make $100,000 in a year or two, 10x is a huge year for anybody, right? So let's just say you could do that.
Yeah.
You're gonna give the government 30 to 40% of that. So you might get $60,000. So maybe she has her initial 10,000 in there, and maybe $60,000. So now you're at 70 after having given the government their 30 or 40, whatever it is. But so if you can 10x your account, you can pull out 65% of it maybe, and apply that to the down payment on your conversion van. So how do we 10x our thing? And that's where we start. We start going down because we can't do it from an IRA.
Right.
So how do we? Okay. Well, what does Bitcoin do? What's the most volatile thing we can do to apply the tools that we use for technical analysis, to generate that kind of money that you already have the goal that you want? And that's just an example of what you can do, or the thought process anyway of how you would do it to create something that you want within the confines of the rules that we got.
And there may be people that are listening to this that go, oh, there's no way you guys can 10x. Now, okay, maybe, but Actually, there are plenty of people out there that we either know or follow or see. I mean, you would be amazed at the amount of people. Now, how much work does that take? Right? It does take a lot of focus, a lot of work. So if you're not willing to put in that work, no, you can't 10x it. But if you know the fundamentals and you know technical analysis, the tools are there. What's great now is that those tools are way more accessible. Yeah. And here's the key. They're more accessible and accessible for the least amount of investment in history.
Yep, definitely.
Right? In history. Fees are almost completely gone. Now, I say almost because they're buried in there a little bit. Yeah. But we don't have to get into that. They're still there, but they're buried way more deeply than when you were talking about before, when you were describing the implications that if she had to, pay capital gains. Mm-hmm. Used to, let's say 80s, 90s, right? You were going to also pay massive commissions, massive fees, right, and those capital gains. Yep. So you were whittling down nobody ever talked about that stuff, right? Now, thankfully, we're pretty much down to just giving it to the gov.
That's without a doubt the biggest piece.
Yeah. And if you have that in perspective, you're okay with it because you're like, yeah, but I'm not paying commission and fees anymore, and I'm my own broker. I don't have to go through, it's automated
and the tools.
Tools are there for. Oh my gosh.
I mean, the tools are free. And you used to pay. I mean, my dad used to pay like crazy money to get access to charts, and they were mailed to the house, and so obviously they're not current, right? Yeah. I mean,
you want to talk about a long-term perspective, Anyway, it's a good story. And I think hopefully that's relatable to a lot of you listening. Again, I'm going to throw this back in there. This whole idea of not having the skin in the game. Our kids are in the military. Our kids have retirement accounts. We have them. We got lots of skin in the game. And really what we want is our kids, I right now my daughter just got out of the Marine Corps, and her husband's still in, but they are way more educated and way more actively managing their retirement than I could have ever dreamed of at their age. And that's going to pay off, right? We know this. I mean, any of us that are listening to this that are, in their 40s or 50s, that if you did this when you were 20, compound growth is like way on your side. Yeah. So hopefully the takeaways here are the point. So back to, me retiring in 2015, right? I knew that I had time to make up a lot of things that I screwed up, right? And so that's what I've been trying to do is to the nth degree, as much as possible, to actively manage to squeeze out. Yep. I'm not going to make 10x in an IRA.
No, and you're not making it in TSP. You're not going to make it in index funds.
No, but I would say that rolling over to an IRA, I was able to increase the X's because I'm actively managing it, which I could never do in TSP. And I'm also trying to catch up, right? And catch up for me is not put more money in. Right. It's milk more money out of the money that I have. Right. So you can use these methodologies on either side of that. The difference we point out, and we can get back to the slides, but it's the brokerage account is where the tax implications normally are. And these slides, when they're saying brokerage account, although because these slides are talking to that.
This is generic for Elliott.
And when the mutual fund windows come into the TSP, you won't have those implications.
Right. You don't have tax implications, right? Okay. So again, this is just an executive summary, and it's from Elliott, and they're an HR company, and this is not specific to TSP. It's an executive summary of what they provide for the mutual fund window. So there's recently been a whole lot of increase in interest in self-directed, a piece of a self-directed account within 401k plans. So I'm not going to go through all of this on every page, but self-directed brokerage window allows participants to establish a personal brokerage account. Again, it's without the tax implications in TSP, but you can establish a personal brokerage account within the employer's defined contribution plan, okay, which is our TSP. There are usually more investment options in the brokerage window than in the plan menu. Obviously, for us, the plan menu right now is the CSI, F, and G, and then the L funds, which are a combination of those. So there's really only 5 options in our plan menu right now. So this gives participants access to a broader array of stocks, bonds, mutual funds, and exchange-traded funds. Those are the things that are available from Elliott, all of them. Okay? Elliott is the platform. It doesn't make decisions for us in TSP. It's just a platform. But those are the things that they provide on the platform. So, can I do that? Let me see if I can zoom. I can't zoom that way. Let me do one, and then I'll go to two because two is more important. So half of large plans have a self-directed brokerage window. So that means, like, if you work for IBM, for example, I have no idea if IBM has this, but if you work for a company that still actually has a 401k plan, half of them have some piece of a mutual fund window in it. Percent of plans that had self-directed brokerage accounts back in 2001, 12%, 2021, almost half. Okay. The really interesting thing for us is number 2. So, plan sponsors can customize the window options. There's a lot of talk about what are the restrictions likely to be. What restrictions will TSP put on us, if any, in the mutual fund window? So, plan sponsors, which is the TSP, may choose to limit options in a brokerage window, while 60% of plan sponsors offering brokerage windows allow for full brokerage options. The remaining 40% limit the investment options in some way. Hopefully, I hope anyway, that we are part of the 60% that doesn't limit the options. Specifically, 9% allow for a mix of mutual funds and ETFs, while the remaining 31% allow for mutual funds only. Hopefully, TSP does not fall into that category of mutual funds only. Employers can also limit the amount workers can invest in the window. 54% of plans that offer brokerage windows have no to very minimal restrictions on the maximum percentage of the balance that can be invested in the window. The remaining plans place a varying restriction on participants. The most common restriction is to prohibit participants from investing more than 50% of their balance in the brokerage window. 19% of the plan sponsors with brokerage window offerings have this limit. So the TSP can absolutely put restrictions on how we use the mutual fund window. It's pretty much unlimited, the restrictions that they can do. They can do whatever they want, and we're gonna kind of adjust not the methodology that we use, but adjust as we go based on what we find out, how this rolls out in the summer of 22.
Yeah, right now we take our methodology within the rules of the TSP.
Yep.
That's what we do. We can't affect 2 moves a month. We can't affect the noon rule. We can't affect anything. We can't do anything about that. So we have to use the methodology within those constraints. That's exactly what we're going to do as soon as this mutual fund window comes up, this window. They call it a mutual fund window in most of the verbiage that we've seen. Hopefully that doesn't mean it'll only be mutual funds.
Yeah, no, they use it in the slide deck, right?
Yeah.
It's called universally called a mutual fund window. Just because it's the title.
Right.
But A-Lite gives you access to every kind of product that you want.
Yep. ETFs, bonds, everything.
Yep. Stocks, individual stocks, anything.
Yeah.
If you imagine if you could buy, it doesn't say in there, but options. I mean, you could buy Apple stock in your TSP, right? And hopefully that comes along with stop losses and buy limits and all the rest of it.
Most people need to buy fractionals, but
fractionals. I mean, maybe that's a part of it too. I mean,
I don't know if you get into one of the slides, but the other takeaway, the other thing to remember, I think, is that with these, I just lost my train of thought. Sorry.
Stocks. You can trade all kinds of different products.
Yeah. The one takeaway. This is one of the things they're betting on. Is although all these plan holders, is that what the term they used?
Yep.
These plan holders, which for us is the TSP, if you go back and look at the statistics of people that have access to this, that actually use it.
Yeah, that's the next slide. Yeah.
It's minimal. Let's take a look at that because that's important.
It is. So overall participant usage is low, but varies by plan. So
I want to zoom in a little bit on if you something you want to point out.
I can.
Because that's
I don't have to write on it. So yeah.
There we go.
All right. So in the aggregate, only about 1 in 40, so 2.4% of participants use the mutual fund window, right? So in all the 401k plans out there that have a mutual fund window option, only about 2.4% of people that have accounts use it, right? While while there are plans that have nearly 20% of participants using the window, almost 90% of plans have less than 5% of participants investing through the window. So what that means is there are very few people, even though they have the option,
that actually do it.
That actually use it.
And the reason, I'm going to go out on a limb here, the reason they don't is because they don't know what to do. Right? So we have folks that tell us all the time, I don't know what to do in my TSP. You got 5 options. Right? Really, if you follow kind of our methodology,
you got 2.
You got 3, maybe 2,
yeah.
Right? What I'm saying is when you got 5,000, what are you going to do?
Right.
It's even more important after this window opens. It's exponentially more important now than ever to get educated.
Yep.
Because if you're educated, you're not intimidated by those options. You're like, okay, I got a little bit more flexibility.
Right.
I got some options.
Yep.
If they tell you can only do 50% of your balance, right? And let's say you got $500,000 in your TSP. If you can take $250,000 and actively manage it in a mutual fund window, now we can talk about 5X. We can talk about 10X.
Yeah.
If you know what you're doing,
yeah,
absolutely you can do that.
Yep.
To be able to do that within a retirement account, like the TSP, right? You can do it in an IRA, but the limits in the IRA as far as how much money I can pour in there, that's the problem.
Right.
I can roll over a big chunk, which is why we talk about it, because if I can roll over hundreds of thousands of dollars, I'm in the game.
Right.
If I have to start from scratch with an IRA, it's a little different. If you give us access to do that in the TSP, this is a game changer. Even if what they give us is not everything, if they whittle it down to some things, it's going to be hard for them to have rules like only twice a month. Got to have it in by noon. It's going to be really hard to
only ESG mutual funds.
It's going to be hard to put those because they don't make any sense in this world nowadays. Yeah. The reason we have in the current TSPs is in the world that existed when they created
1985.
This. Lots of fees, lots of built-in things that says, okay, we can't have you day trading because you're going to kill us in fees and this won't be inexpensive and we got to pass those on to you. Yep. A lot of that makes sense. The noon rule, it's hard to convince me that makes any sense. But the point here is, so few people ever even use this when they get access to it. So if you're listening to this show, please, please, please get yourself educated. Don't care if it's our way or your way.
No, if you're yourself educated. If you're using like a fundamental strategy and not a technical analysis strategy, if you use a fundamental strategy,
it's a good time to use it.
Yeah, if your friends or your family or your dad or whoever works in the energy industry, right? And they it's not that they have insider information, it's just that they understand how the industry works. They understand the cycles, they understand how it works. And maybe you grew up learning how that stuff works. Now you work for the government, you don't have anything to do with it, but now you have a way to sort of exploit knowledge that you got through, by luck, basically, in your life.
Yeah.
Well,
some people understand the energy industry better than they do, let's say, textiles.
Sure.
Right. My family built furniture and was in the textile industries for a long time. If I tapped into my grandparents and parents' knowledge, I could get educated on that industry better than I could. I'm a tech guy. I like tech, so I understand tech. Yep. Right. And tech seems to produce a lot, and everybody kind of focuses on it. Well, I'll tell you what, I was in tech when in 97, 98. Anybody know what that time frame was? It's called tech bubble.
Yeah.
I'm telling you,
tech doesn't always go up.
It doesn't always go up, and I can attest to that. But I will tell you that getting educated can help you when you have 5 choices, and it can help you when you have 5,000. Yep. You will not be intimidated if you are educated. It's just like anything else, right? Options tend to put people in paralysis. Yep. Paralysis by analysis. What do I do? I'm telling you, folks, we're going to take whatever they give us, and we're going to whittle it down to a usable world of options, and we're going to apply the same exact methodology. Yep. That may be 20 options. It may be 50 options. It's probably not going to be more than 100 options, and I would argue it's going to be less than 50 because you can't, right? Yeah, unless it's your full-time job, it's literally everything you do all day long.
I mean, we're looking at I'm thinking through a lot of different ways, both for my own personal TSP. How am I going to how am I going to do this when the mutual fund window opens? And how are we going to put this thing together for the show and the members and stuff?
Yeah, it's usable.
What's usable?
You can wrap your head around it. But I have every option available in the world in my IRA,
right.
and I don't use them because I understand enough about a small piece of those.
Right.
Now,
right.
What's nice is, I don't have just the S&P 500. I've got all 11 sectors. So if one or two of the sectors is outperforming the S&P 500,
right.
you can beat the S&P 500 pretty easily.
Sure.
You have to have access to its components.
Yep.
That's a very simple example of what we'll be able to do with this window, and you listening or watching will absolutely be able to do. Right now, if you're one of these buy and holders with the C fund,
yep.
and you're like, great. Think about it if you bought and hold two sectors within the C fund.
Just the XLK, just the tech sector.
That everybody says has outperformed. So yep. you would at least 2x, if not 3x.
Yeah, the S&P. Yeah.
By far. And you want to brag now? You brag then.
Huge then.
But you're going to have to dig into those elements, and you're going to have to know which ones are which. Right. But yeah, it's lots of exciting things getting ready to come.
There's a lot of possibilities, and we'll be talking about it over time here. Okay. So some other kind of interesting stuff from these slides. So most people don't use the mutual fund window option. That's the bottom line with that. Of the people that do, they tend to be older and higher paid workers are most likely the ones that use a self-directed window. So participants using self-directed brokerage tend to be male, older, higher salaried, higher tenured. It's all people that are getting near retirement, have more money, are trying to grow their retirement. They might have maybe more time. They're working, but maybe they're at their desk and no one's looking over their shoulder, and they have some time to actually manage it. I think that's kind of, I would go out on a limb and say that's probably the case, right?
But Jerry and I talk about this all the time because our kids are in that that 20s age group, and I've been impressed that age group is far more. I don't know if they're not necessarily educated, but they are far more interested in all of this than we ever were at that age. Not Jerry. I mean, Jerry grew up doing this, right? Your dad was into it. Yeah. My family was too, but not as much as they should have been. The point here is, though, I think those statistics are gonna change. Yeah. I think you're gonna see if we look at that slide, that Jerry has up there, in about 20 years, you're gonna see
the 29 group is gonna be
that group is gonna explode. And I think the 30 to 39, all in there right now where that's really low, it's going to shift. It's going to be fun to watch.
Yeah. Yeah, it is. There's a lot of changes coming. Okay. So participants within the self-directed brokerage account tend to have large 401k balances. We kind of talked about that. It's the same kind of idea. Basically, people with higher balances tend to gravitate more to the mutual fund window. Okay, that's kind of the idea. That's pretty much the end of their slide deck. It's just, again, it's not TSP specific. It's kind of an overview of who uses their products. The Alight, the company, is an HR services company. So when they put out these products, they're not really intended for us, the end user. They're more intended for, in our case, the TSP board that would look at it and decide.
Those are the people that are reading these slides, not normally individual investors.
Right.
Yeah.
So this is a pretty good look behind the curtain, basically, is what I'm saying. All right. Okay. Much more to follow as the time gets closer. So back to the present. The current Elliott Wave count with Andrew's pitchfork. We've done this slide or something similar to it for the last several weeks. This is the weekly version. I think the last couple of weeks we've done the daily version. This is the C Fund 1 year, 8 month weekly chart. So each one of these ticks, right? It's called the tick. Each vertical line represents 1 week of price change. So when you build the Andrew's pitchfork, you take a high, which back here was the low from COVID. So the market went up, and the first significant correction was right here. So if we take the high, they call it a swing high, and the swing low, and you let the software project out, this is the Andrews pitchfork. And so it's basically just, it draws the expected channel line going forward for you. And we can see that over the past year and a half, 2 years almost, it's run really well through the channel, and the median line is pretty important because on a weekly basis, we've gotten support pretty much throughout along the median line. And we still got that during November, December, where we were all kind of freaked out that the market's rolling over. So in the big scheme of things, until we get a significant break below that median line, we're in good shape. And when we add in the Elliott Wave count to that, again, we started back here. So here's the low from COVID. The market moves up. This is the 1, right? We got an ABC for a 2. And now we're looking for the 3. At some point, the 3 will complete. As of Friday, you can't see it all that well on this chart, but as of Friday, we closed at a new all-time high. And we haven't broken that median line yet on a weekly basis. We haven't closed below that median line. So I'm reading that as wave 3 has not yet completed. We talked about how back here, wave 3 could have completed right there, right? Because we had the sideways consolidation, the market was coming down, coming back up. We had the sideways consolidation, but now we're back to new highs. So they're not huge new highs, right? We still definitely, if you look at it, it's pretty much a horizontal line is still there, but we're gonna get into it in a minute of why. But I think the market keeps going higher, and at some point we get to a 3. When we get to that 3, we do some kind of correction that comes down here and tests that lower channel line, right? There's going to be a lot of people freaking out right here, but we're gonna come down, test that lower channel line, and that'll free up a whole bunch of sort of spent up demand at that point to give us a 1, 2, 3, 4, 5 up to the 5. And then when we get there, we'll talk about that.
And I promise not to post any memes.
Yeah, don't post memes about when the 5 comes. It's going to be very exciting. Put it that way. But at this point, I don't think that the 3 is in. I think the 3 is still to come. Okay. Bonus chart for the week is Bitcoin, not Bitcoin itself, but Grayscale Bitcoin Trust. So if we look at this is a 16-month daily chart of Grayscale Bitcoin Trust, which is, it's a way to trade on the movement of Bitcoin without actually buying Bitcoin through an exchange or through a Bitcoin wallet. So Grayscale Bitcoin Trust made a double top in early November, right? We got this top, and which basically this whole thing was a top. So we have a double top in early November. And then in the past several weeks, we've given up almost all the gains from October, right? Volume has been relatively low. Let me try to zoom in on that. Volume has been relatively low in December and November during that decline, which means there aren't that many sellers, right? We got to oversold levels back here in the beginning of December, and we've stayed basically bounced off that oversold line as the MACD continued lower, but it just turned back up. So the lines just crossed on the MACD. Relative strength has turned back up, and we had a 5.77% gain on Friday. So it looks like a pretty good bottom is in here, right there. So
yep. This is a good chart to kind of think about this idea of buy and hold methodology versus, our methodology, which is we don't have a name that kind of, and we're not the only one that has this methodology, but, being in the stock funds when it's trending up and being out when it's trending down. So I like this chart because this is a good example. So in my IRA, right, I have Grayscale Bitcoin.
Yep.
And I also own Bitcoin.
Yep.
Right? So I would consider that my brokerage account, although it's technically a little different. Right? The point is, using our methodology, I was out somewhere in March. I don't have any of this in front of me. I don't have the exact dates. And I was out through end of September, right? In my IRA, right? Because I'm not going to take hits for that tax-wise.
Right.
In owning Bitcoin, I'm buy and hold all day, son.
Yep. So am I.
All day.
I dollar cost average Bitcoin. Yeah.
First of all,
of course.
And I look at Bitcoin a little bit differently. Like Jerry is probably way more. He's doing it the right way, I would say. Where I have a little bit more emotion in Bitcoin because I am a 1,000% geek. Where I know what Bitcoin's potential is. I know what the blockchain's potential is, not just say Bitcoin. I know what crypto and the blockchain can do. I know what it's going to do. Like NFTs, like I am all up in that, right?
Yep.
And so I'm looking long term and long term possibilities. And buy and hold is when I don't want to take those tax implications in that chart right there.
Yep.
I'm not taking them
in a brokerage account. It's
when
huge.
I know. I don't know. Yeah. Right. When all the data, all the fundamental analysis that I've done says to me, "No, man, just we're fine." Right. Yep. That you got to, and I don't watch it. I literally don't watch it for the actual Bitcoin. For my IRA account, oh no, I was out. Once that trend changed, I'm out. And I'll wait till there's a trend that comes back, and I'm not going to get it perfect. Right. But I saved a lot of my account by getting out,
right? Definitely,
and waiting it out. I think draw that line across where let's just say like late March, mid March. I can't really see.
You had a double
if I got out, that
somewhere in there.
No, forward to that. I didn't get out until like March.
Yeah, well, that would make sense because we hit a high.
Yeah.
We couldn't get back up to the prior high, and then it rolled over. So if I assume you got out like somewhere right there, which is
I got a little later because I don't watch it as closely as I should, but that's because I'm not.
I mean, mid-March is good.
I'm not looking to catch the top and bottoms.
Yeah,
I'm looking to just follow the trend. So I hope everybody gets that why I'm pointing that out, because when folks get confused about these guys do it, we do it the best way we can given the options and tools we have.
We're trying to make money.
Well, first of all, yes.
I mean, we use all the tools
I would say
we know how to use to make money.
We're trying to make money, but let's go back to our first rule. Number one is
don't lose money.
Don't lose money. And in that chart, I think, and for me, that's a perfect example of in my retirement account. That could be a 401k, TSP, IRA. In that account, I do not want to lose that money. Right. In my brokerage account or owning cryptocurrency, I don't want the tax implications, and I have enough fundamental data that tells me it's going to go higher.
Right.
So I'm going to buy and I'm going to hold. That's the two different things. It's not that one is better than the other. You have to use what works in the options you have.
So I think I don't know if it's going to be a weekly update show or one of the members only webinars or a public webinar, but I think I'll put together this idea of so you have short-term capital gains and long-term capital gains, right? You got a brokerage account and an IRA account. If I don't have an ability right now to pull this chart out to like 5 years, but if I could pull this out to 5 years, we are actually in the foreleg of the crypto of the Bitcoin chart right here, right? So I am dollar cost averaging into Bitcoin, right? In an exchange. I haven't pushed it into a wallet yet, but I'm buying actual Bitcoin because I'm looking at a long-term chart, and the same as you. I'm not selling in the foreleg. I'm accumulating in the foreleg. I'm not trying to catch the ups and downs of the market. I'm accumulating in the foreleg because I expect the fifth leg to come. And I mean, if you do the projections, Bitcoin at 100,000, 120,000. I mean, I have Bitcoin right now at about 140,000 is where I would start to look at it on a shorter term level at that point.
You're going to start zooming in.
And then start to think about selling it.
Yeah, you're going to start zooming in.
But it's going to be more than a year. I'm going to take the long-term capital gains
instead
tax.
of the short-term.
Yeah, set it aside.
Absolutely.
Wait for the ABC correction. So you're combining sort of the buy and hold with a backdrop of some kind of a reason for when you would buy and when you would hold.
Yeah.
Yeah,
and it's for it's the tax implications.
Yeah, it's huge.
It's just about whether, do I want to I want to give away, if you happen to live in the U.S. Virgin Islands, none of this applies to you. But,
yes, that's another show.
Yeah.
All right.
Moving on.
Let's get drill down a little bit. So back here, this is the 16-month daily chart, right? If we drill into a 3-month daily chart, so this could be any stock, it just happens to be Grayscale Bitcoin Trust. We hit a top at 50, I guess an intraday at about $55. We've come down in an ABC correction, right? This past Monday, we put in a reversal day right there. If we connected the trend line, the short-term trend line is right here. So on Monday, we had a reversal day. On Tuesday, we gapped up and closed just above that trend line. On Wednesday, we consolidated a little bit, and on Thursday, we got a 5.77% breakout. So that breakout definitely confirms that this trend line should hold. The next resistance level is this longer-term trend line, which started at the top and hit this was the ABC correction, right? Hit the top of the B. We connect those lines. This is going to be the next area of potential resistance. From a shorter term perspective, right? I said I was dollar cost averaging into Bitcoin, which Bitcoin the actual coin, but on Thursday I bought a lot of Grayscale Bitcoin Trust on that breakout, just for transparency. Yeah.
Not advising you to do
Not
that.
advising you to do it, but I'm telling you that's what I did. Now, if it rolls over, so are we still on the chart?
Yep.
Okay. If it rolls over, what does that mean? If it gets below 35, because here's the gap. Say I let it come down to fill the gap. I'm like, all right, I'm willing to take the loss down to fill the gap, with the possibility that it has to fill the gap before it goes higher. Okay, no problem. If it gets below this intraday low right there, I'm out. I'm still dollar cost averaging into Bitcoin, but I'm out of Grayscale on this short-term trade.
Because they're two very different things.
Yeah. You got to be able to keep multiple time frames and multiple accounts and all this kind of stuff. If you're going to play this game, you got to be able to know which bucket your money's in at which time and what tools apply to it.
And you can take a version of what we're showing you here to do a much more minimalized version. We talk about that all the time, where you don't need to go buy Bitcoin. You don't need to go, first of all, don't do anything you don't feel comfortable in, right? The point by all of this is we go into these other charts because we want to put it in perspectives outside of the TSP for you to see that these rules, these methodologies, these principles can be applied throughout the market. Right? We didn't come up with this. Market technicians have been around for a long, long time, since the market has existed, right? And so in the TSP, fundamentals it's very difficult because you're talking about such a large group of industries and companies. And so it makes it very difficult. You can still do it. It's a lot of work. So we stick with technicals. When we get outside of that scope, absolutely we're looking at fundamentals. And what fundamentals do is help you hone in on the areas where you can apply technicals. I challenge anyone out there to find a successful fundamental, a successful fund manager, right? Who's managed funds that doesn't use both.
Both, absolutely. The fundamentals tell you, they show you what sectors to be in, and technicals tell you when to buy or sell.
Absolutely.
They work hand in hand, 100%. And so back to one other thing before we get off of this and get onto the TSP charts and kind of wrap this thing up. We were talking about how do you 10x something, right? Let's say I bought on the breakout here, it was 36. Let's say I bought it at 37. 37 times 2 is 72. 36 times 2, rather, 72?
I'm not the math guy.
All right, so
I
72.
don't have a phone hand.
So say we get up here. So that's if you could draw this trend line back here, we're still not even there. If we can get above 55, because this is the prior high, this is going to be the next resistance point once we get past this line. But if we can get up here, that's 100% on the money, right? If I can make a 100% move, a couple of them, pretty soon I got a conversion van.
Yes.
You know what I'm saying?
Your daughter does.
Yeah, my daughter does. She might let me borrow it once in a while. Okay. TSP stock chart fund. So 2 year weekly charts. So until we get a break down, a weekly close below that 10-week moving average line, which is essentially the same as the 50-day moving average line, the market just keeps chugging higher. It doesn't matter about all the machinations that we're having here for the past several weeks. We've got some down weeks, we've got some up weeks, but we're staying above that 10-week moving average line. This doesn't look very good. We got two weeks of high volume selling. That's not great, but it's not really reflected back here in the MACD, and it's barely reflected in the relative strength. So everything is still positive. We had low volume this week because it was a holiday shortened week. People are out of town, and we only had 4 trading days instead of 5. So I wouldn't worry about volume there. And we closed the week out at a new all-time high. So C fund looks good, which is our proxy for the overall market. So no reason not to be in the stock funds at this point. S fund is the worst of the 3 still. It was a big week, right? We're up almost 3% for the week, but we closed below, we're hitting resistance there at the 50-week moving average line. And so we need to get up above that and up above the 10-week before we're really back into the trading channel and not have to worry about a rollover. But you got relative strength right here, trending up, and MACD, the crossover hasn't turned back up yet, but the histogram is higher this week than it was last week. So S fund isn't the best looking chart. It's actually the worst of the 3, but it's not horrible. Okay. I fund is actually pretty good. It's similar looking to the S fund, but we did get support on the I fund at the 50-week moving average line, and this week it got support there and then closed above its 10-week moving average line. We also got the relative strength moving higher and the MACD looking like it's ready to cross positive. So the I fund is definitely looking stronger at this point than the S fund. The F fund, interesting because the price basically, so the price right here, the 10-week moving average line, the 50-week moving average line, and the price is all at the same place right now. Like, I can't imagine more of a no man's land. Where you got a high, a lower high, a lower high, a lower high, right? Which is bearish. The trend is down. But we have a low, a higher low, and a higher low. So we have this triangle pattern forming. It's going to break one way or the other at some point. Right now, we don't know which way it's going to break. So once we know, we'll identify which way it goes. I mean, we could draw this short term here, and you get support here. Either it breaks down below that support level, or it breaks up above that downtrend line, and then you're going to know. And it's going to be reflected in the relative strength and the MACD. So as soon as we see it in the chart, we'll know whether or not to be in the F fund. Of course, I would only be in the F fund if the stock funds were trending down, because you're not getting the same kind of rate of return in the F fund that you do in the stock funds.
Questions?
That's all I got. That was a long show.
Yeah, it was long, but it was good.
It was good. A lot of stuff in there.
A lot of good info. Hopefully,
a lot of stuff also in the newsletter. I'm doing a weekly and a daily look at the stock funds, because the weekly charts this week put in what's called a bullish reversal candle, and we go into a lot of why this week. If you remember, November, the market was tanking. The first week of December, we ran back up, but then the second week of December, we did this thing called the dead cat bounce, right? It came up, hit it, and then it came right back down. This week is different in terms of the chart pattern and the meaning of it. So definitely read the newsletter. It goes into much more analysis of what this week means in the bigger scheme of things.
Yeah, if you're a paid member to our a paid subscriber to our site, you get access to the newsletter. It comes out every Sunday at 6:30, 6 o'clock, somewhere in there. And my advice to you guys, if you hopefully you watch the show and do the newsletter, because you put the two together, you get more analysis on the TSP than you can get anywhere on the planet, bar none. But what I tend to do, right, because I'm not watching this. I don't remember half this stuff when we get done. But I would advise watching this on Sunday evenings, right? Monday mornings, read the newsletter, Jerry does a little companion video for the newsletter if you're more kind of, audio visual kind of person. Plus, it's nice to hear Jerry explain it. But anyway, I would consume the newsletter Monday morning, make your plan for the week, and do that every week. Sunday evenings, watch this. Monday mornings, watch and read the newsletter, make your plan.
Yeah.
Right?
It's a great way to do it.
Dude, that alone will put you so much farther ahead than most people.
It gives you a basis, at least. You're not just
you're in a ballpark. You understand where you're at. You see where you want to go. You see where you don't want to go. You will spend. So if you do that on Sunday evenings and Monday mornings, you can forget about it Tuesday through Saturday.
Yeah, because if something happens, you're going to get the alert.
Exactly, that's true. You're going to be able to validate it with what Jerry's doing. All right, guys, we got to roll. It was a long show today. Hope you got a lot of value in it. If you enjoyed the show, please share it with your friends. Tell everybody about it. If you didn't enjoy it, share it with your friends. And I hope you all had a good Christmas. If you celebrate another holiday, Hanukkah, Kwanzaa, anything else, we're in that holiday season. We really hope you and your family get time to spend together. And we will not be here for New Year's. We did an interview with our friend Scott Zane from the Thrift Savings Plan Facebook group. They've got like 75,000 people in there, and we're going to be posting that next week. And let me tell you something, guys. This is an interview you will not want to miss, because Jerry and Scott talk about how they approach this in different ways, but you're going to see a lot of overlap, and it's a great takeaway of looking at people's different perspectives. Right?
It was a great interview. It's our first one that we've done, and we're going to do some more of them, but definitely check it out.
All right, guys, have a great week, and we will see you soon. That was kind of loud.